The city of Maynard Keynes. From his corner office vantage point, the president of the central bank looks out across the city. But something troubles him. High unemployment, stocks piling up the warehouse, very low production levels at the factory. The central bank's president decides to inject some cash into the economy. To do so, he buys some government bonds from the capital market. Thanks to the sale of government bonds, the commercial bank now has high cash reserves. But cash earns a low interest rate compared to other assets, so the commercial bank wants to make its money work. The bank offers the owner of the factory an attractive deal on a loan, which he accepts, hoping to diversify his factory's products and improve sales. After expanding the factory, the owner realizes that he now needs more employees to handle the increased workload. Increased employment at the factory has two important consequences. Firstly, the pool of unemployed workers drops. Secondly, the increased competition in the job market means that wages will rise. With this increased income, households can afford more goods. As the stocks at the store begin to shrink, the overall price of goods begins to rise. Sales remain high, and the store can now order more goods from the factory. And so the cycle begins again. The factory hires more workers, wages rise further. Meanwhile, the finance minister is also increasing her income. More taxes coming in from the sales taxes and income taxes, and less is spent on supporting the unemployed as more people return to the workforce. All these factors mean the government begins to run a surplus and can start to repay some of its debt. The government buys back some of its previously issued bonds from investors and banks. As their cash reserves increase, interest rates decline again. The low interest rates means borrowing is even cheaper, which stimulates the economy further. The city is now in full recovery from recession. The view from the central banker's office is very much improved. High above the city of Maynard Keynes, the president of the central bank looks out his window and is pleased with the view. The economy is booming, thanks to the bank's previous efforts in boosting the supply of cash. Seeing the economy doing so well, he decides to let it run on its own. The city's workers are now earning more money, and more of them are employed, so the retail banker thinks the risk of lending money is now quite low. Hoping to win more votes, the finance minister announces that the government is in favor of more people buying their own home. She tells the commercial banks they don't really need that much collateral when providing mortgages. So the commercial banks offer cheaper mortgages to working families. As more families start buying houses, house prices begin to rise. The banker notices the value of houses rising and continues offering attractive mortgage rates. The ongoing housing boom creates a cyclical effect. Families feel wealthier and so sell their houses and move to a bigger one in a better neighborhood. With more people moving, the house prices rise further and families continue to upgrade their houses and mortgages. Families start to use their homes to generate cash. Using the excess money from their mortgages, they can start to buy washing machines and cars. Prices of goods and services begin to rise faster. To the finance minister's delight, the tax income of the government has increased. But the president of the central bank is not so delighted. He sees the prices of goods and houses rising faster and faster. Can he stop this from getting out of hand? The president of the central bank is not enjoying his corner office view across Maynard Keynes. Worried that his efforts to boost the economy have worked a little too well, he sees prices are spiraling out of control. The central banker decides to put the brakes on the economy by taking some money out of the market. So he sells some government bonds to the capital market and the bank in return for cash, causing the price of bonds to fall. Over at the commercial bank, the banker now has less cash on his books, and his remaining government bonds have fallen in value. This creates an imbalance between the value of his cash and other less liquid assets. He needs to make up the difference with more cash. Unfortunately for the factory owner, this means that the banker is going to raise the interest rates on his loans when he renews his credit with the bank. Instead of borrowing more, the factory owner decides to slow down production at the factory so he can lay off some workers to save on the wage costs. Newly unemployed, The laid-off workers and their families find they can't pay their mortgages. They appeal to the banker, but he tells the families they've broken their contracts and so must move out of their houses. The bank forecloses on unpaid mortgages and repossesses the houses, trying to sell them to generate cash. However, many families are now in the same situation, so the price of houses starts to fall, and the bank can't sell the ones it owns. Unemployment also begins to bite into the profits at the store. The unemployed can't buy as many goods and services, and stocks in the supermarket start to pile up. A cycle emerges. The supermarket manager tells the factory owner that she needs less supplies, and so the factory owner ends up laying off even more workers. Once again, the central banker is worried that his medicine has worked too well, but this time in the other direction. Prices are falling. The banks have stopped lending. Production is slowing. The economy is on the verge of collapse. The government is also disappointed. There is less tax flowing to government and more expenses supporting the growing number of unemployed workers. Luckily for the finance minister, the government can still borrow money from the finance market because savers are still investing in government bonds. But this increases government debt. Banks and companies are so cautious now that they neither lend nor borrow. The economy is stagnant, in a deep recession and heading for depression, as is our central banker unless he can come up with a solution. The president of the central bank surveys the scene below his office tower, but the city of Maynard Keynes is not a pretty sight. All of the central bank's work to increase the cash flow in the economy has been in vain. The economy has fallen into a downward spiral. Many workers are unemployed. Banks and companies are neither lending nor spending. So to prevent the country's banks from collapsing completely, the central bank and the finance minister decide to bail them out. The central banker buys mortgage bonds and corporate bonds from the banks, thereby supplying the banks with cash. But the banker is still cautious. He doesn't lend the cash to anyone and invests in government bonds, which the finance minister is issuing to try to provide more capital to the banks. In addition, the finance minister has to sell some more government bonds to raise funds for unemployment benefits. But she doesn't stop there. The government goes directly to the factory and places an order for widgets, which she hopes can allow the factory to hire more workers. As more workers are hired by the factory, some families can go shopping again. And at last the huge stockpiles in the supermarkets drop a little. However, because both salaries and taxes are still fairly low and the government is paying for widget production and unemployment benefits, it's easy to see why government debt continues to rise. The commercial bank grows worried. What if all those government bonds it bought don't get repaid? It tries to offload the bonds and bond prices fall. Interest rates rise. Rising interest rates slow production because the economy is not strong enough to withstand higher rates. The government revenue remains low and it cannot borrow anymore because no one is buying government bonds. The city is in a debt crisis. The central banker can see only one way out. As much as he hates to do it, he tells the finance minister that he will buy any bonds that the finance minister issues directly into the central bank's coffers. These funds are then distributed directly to the population by the finance ministry. This is also known as helicopter money. Of course, in reality, this would be achieved through providing subsidies or cutting taxes. After the helicopter money enters the economy, prices start to rise. Inflation is back. It's a cloudy morning in the city of Maynard Keynes, and the president of the central bank is uncertain as he looks out his window. The city is still suffering from the after effects of a housing boom and bust cycle and high government debt. Many other economies are currently doing better, but the central bank and finance ministries in these other places have also been through a cycle of increasing their money supply and boosting their fiscal deficits. As a result, their economies are in the midst of an economic boom. Because a booming economy needs a lot of energy, oil prices rise. As a result, the factory owner has to pay a lot more for oil, forcing him to raise the price of goods he's supplying to the supermarket. To the workers, the price hikes look like inflation. But the workers are not receiving higher wages, so they buy fewer of the increasingly expensive goods. Once again, stocks start to pile up at the supermarket. The supermarket owner calls the factory and lowers her orders. Yet again, the factory owner must lay off some workers as production begins to fall. Wages also begin to fall, resulting in even less buying power. The supermarket owner watches stocks rise and considers cutting prices. Overall, this means that the rise in oil prices doesn't cause lasting inflation unless the central banker becomes worried and moves to stimulate the economy by increasing the flow of money. And then we're back at the beginning of our journey. Something troubles the central banker, who looks out from his office and sees, remember? And so the cycle begins again.